Great. All right. Thank you guys so much for hopping in. Again, thank you for taking the time out of your day. I'm sure everyone has 1,000 things going on, so we understand. Again, I mean, Chris, you're literally standing at a trade show right now taking this. So again, thank you guys so much for jumping on. But we can go ahead and get started then. So first, we are going to be hearing from Klim. He's going to be going over what buyers really want in 2025. And it's going to be, the flow is going to be typically around a 10-minute presentation. And then we have some questions at the end. But as you have them, feel free to add them in the chat and I can always just pick from them afterwards. But with that, Klim, I'll go ahead and let you go.
Cool. So guys, do you see my screen?
Yep.
Yeah.
Awesome. So today I'll just speak briefly on what to expect from your exit in 2025, 2026, how to prepare for it, what are the market multiples, and yeah, let's kick it off. So my name is Klim. I've been with Accel Club for around 5 years since the start, and Accel Club, we're an FB aggregator, so we acquire brands on Amazon. So right now we have 15 brands. We're growing 70% year over year, and right now we're due around $150 million in sales annually. So we still acquire brands, and my main function in the business is actually to speak with different founders and acquire brands. And in the last 5 years, I spoke with more than 1,000 founders and saw P&Ls of the same amounts of the business. And definitely there are some insights and some interesting things I can share. So let's start with the first one is actually who is buying your e-commerce business. So there are several types of the buyers who may be a fit for you. So the first one is actually like the private buyers. And these can be found through marketplaces like Flippa, Empire Flippers. These are usually person-to-person transactions. And then you just find an investor who is interested in stepping his foot into your niche and wanting to acquire a brand. So there are some pluses and some downsides of the private buyers. So the first one is actually the deal speed. It's pretty quick. You can get your business sold in less than 2 months. DD is very quick, due diligence. And also there is no involvement on your end after the deal ends. But on the downside, the multiples are pretty low. Usually private buyers are acquiring brands that are on the smaller end of the things, below 3 million or something like that. So if you're bigger than that, probably you would want to consider aggregators. So aggregators is also like the companies like ourselves, Razor Group, for example. These were formed around 5 years ago, and they were operating specifically in D2C and Amazon markets. So the idea is to find some find some kind of private equity, I would say, that would acquire the brands and acquire active Amazon D2C brands. So in terms of the pluses, the transaction speed is rapid, due diligence is quick, multiples are usually pretty good. These are market multiples, and also a big plus, founders shouldn't be involved after transaction ends. Though only a few aggregators remain active, and it would be hard for you to find an active aggregator that would acquire your brand at specific niche. So some of them are focused on baby, some of them are focused on cosmetics, but still there are not much of them left. If you're on slightly bigger end of things, you might consider strategic buyers. These are brands like big holdcos or brands in your own niche. For example, you sell in cosmetics, you can go to P&G and try to sell your brand to them. So the deal speed is pretty long. It can take up to 2 years, obviously in some extreme cases, but I've seen cases when it takes 2 years to close a deal. Though the multiples are great. So this is the best multiples you can get. They're from strategic buyers, the companies that operate in the same space as you do. On the downside, the founder has to be involved in the business because when strategic buyer acquires a business, they're not only looking for healthy P&L and adding the money to their current structure, they also want fresh brains, I would say, to join their company. And they're very interested in your ideas and your vision. And that's why they would usually include in their contracts that you have to stay for several years. And the last type of buyers are different funds like private equities, VCs, family offices. The deal speed is also pretty long, sometimes can take up to 2 years, though the multiples are great. But there is one downside with multiples. The significant part of the deal can be performance-based, and usually private equities do that. So what they do, they keep founder inside the business, and they give them a KPI. Let's say, grow business 100% over the next 2 years. And if you will do that, you'll get a great multiple. But if you won't do that, your multiple can be cut in half easily. So in short, these are 4 different types of buyers that can be suitable for your brands. We'll also take a look on a size scale. Who would you fit depending on your current size of the business? If we're talking about regular deal structures, so there are usually 4 parts that can be included in the deal. First one and the main one, cash at closing. So basically that's a part that you earn after the transaction is closed. You just receive it into your bank account, and you can use that cash. The second 2 things are earnouts and stability payments. So both of them are performance-based payments tied to the future results. The only difference is that earnouts are usually based on growth. For example, you will receive 1x of additional payout if your business grows 50% over the next 12 months, while stability payment is aimed more at stability, as it says in its name. So if your business won't fall over next 12 months, you'll receive a additional part in the payout, let's say 1x. And also sometimes that's a rare thing, but also royalties can be included. So that's a part of the payment tied to the unit sold. So depends on how you negotiate it. You can negotiate royalties for your brand where you receive, let's say, $0.50 for every unit sold over the next 10 years. Sometimes it can be lifetime, sometimes it can be for several years, but it usually works for very unique brands that have some utility patents under the product. So they're backed by some science, they're very unique, and then you can for sure negotiate royalties. If we're talking about main metrics that are affecting your business valuation, the main one is actually your EBITDA and revenue size. So the bigger you are, the more interesting you are for especially strategic players, strategic brands, and strategic hold companies and private equities, VCs. They would consider you if you do more than 50 million a year in your revenues. So that's, I would believe, like the lowest threshold for them to consider you. But if you get to that level of at least 50 million a year in your revenues, then definitely you can expect higher multiples and premium valuations. I'll also show you the case a bit later of one brand that got an insane valuation from a strategic buyer. So the next one, also the second important thing, is your year-over-year growth. So you can see on the right side, there is a benchmark. So 20% considered generally in this space as a healthy growth. If there is something higher than that, let's say 80%, this definitely drives a premium multiple. So let's say you're growing 20%, you can expect like a 3-4x multiple. If that growth is proven and you can prove you'll continue growing in a tempo of 80% a year, you can expect like 5-6x multiples. So growth is very important, key factor. The third thing is your EBITDA margin. As you know, right now, profitability is king. And the higher EBITDA margin you have, the more flexible your buyer can be. As we know, like the situation is truly unstable right now. Tariffs, like different fees increases, they influence EBITDA margin a lot. And then buyer acquires a brand with a 30% EBITDA margin, they were for sure more flexible than acquiring like a 15% or 10% EBITDA margin business. Because if something happens, their margin drops and they're not flexible, they're not able to grow, they just can't sustain and try to, just wait for better times to come. The fourth one is the retention rate, and that's a game changer, especially important in FMCG. I've heard many of you guys are in closing space. It's also important for a closing space. And if you have retention rate, that definitely drives the premium to your multiples. There is no benchmark. You should always benchmark versus your peer companies in the space. But if you're selling like a one-time hardline goods, I don't know, like ball pump, acrylic markers, definitely your valuations at the same size compared to a brand with retention will be much lower. And the last point is obviously your market share. The more control of the niche you have, the more stable your business becomes. And that is highly valuable by the buyers. So let's talk marketplaces. For example, you're selling on Amazon, you have one item in top 10. That's not really sustainable. But if you have 4 or 5, that means the buyer can lose one there and can rely on the other 4, and they will be fine. So that's very important. Your market share, the bigger your presence in the niche are, the more stable you are. So these are 5 key factors, just to sum them up: revenue size, revenue growth, and both EBITDA size and EBITDA growth, your EBITDA margin, retention rate, and market share. And if you nail all 5, you can get a very high valuations. So let's quickly go through the current multiples on the market. I just split them in 2 parts. First is hardline goods, basically the brands and products that are usually bought one time and there is no retention. And the rest is with retention. I highlighted this FMCG space, but it can also be, related to clothing space. And let's have a look at what we have here. If you're in hardline goods, if you are on the lower end of the things, you can get from 1.5x to 6x at the biggest. Usually that's the truth right now. The markets fell a bit from what we had 2-3 years ago. And right now, for a mid-sized brand, let's say $10-30 million, you can get around 3 to 4x multiple if we're talking one-time purchases. In FMCG space, though, and in retention space, the picture is very different. You can start from 2x and you can get up to 12x and even more in some extreme cases. That's all because of the retention rate. Next, let me show you one case. That was the acquisition of the hero company, Mighty Patch brand. That happened several years ago. And that's a perfect example of a company that, had all the 5 pieces in them, which drove them a crazy valuation. So they were number 2 brand in pimple patch category. And before acquisition, we were making $150 million with EBITDA margin of 40%, which is a very crazy margin. You rarely see that. And to be honest, there are not much brands that can do that. But if you have these margins and this size, you can really expect high multiples. And these guys were sold for $630 million. That's a 14 times EBITDA multiple and 5.5 revenue multiple. So as I said, guys, if you can nail all 5 of this, you can hope for such great multiples. And the last point we'll speak about is who to sell to. So if your business is smaller than 3 million, you probably worth to consider private buyers, because strategic, as I said, they're not really interested in anything below 50 million a year. And aggregators probably also will not consider that. Though if you're on the higher end of the things, around 3 million, you can consider aggregators, and you should try them. There might be a chance if your product fits their category and they can acquire you. So if you're somewhere between 2 and 50 million annually, just try aggregators. You'll get a fast transaction. You'll get a good market multiple, though it won't be a great multiple like in strategic. But if you see an opportunity to grow above 50 million, that's definitely a great time to start approaching strategic and funds, because there you can get a next level multiple. So you can cash out at more than 6, 7, 8x. And yeah, definitely worth trying. If you're, let's say, as I said, in clothing space, just find a big clothing brand, try to reach out to them. There is a big chance they will be interested in acquiring you, or at least you can start the conversation and see where it goes. So that will be it for my part, guys. If you're ever interested in speaking about your exit, we can for sure speak with you. We can have a good chat. And if you have any questions anytime, feel free to reach out, and we'll be happy to speak with everyone. Thank you.
Thank you so much, Klim. We still have a couple minutes. Does anyone want to jump in with a question at all? Again, feel free to either type it in the chat or unmute and just hop right in. No takers? Okay, in that case, Klim, we do have a few questions I was going to ask actually. So this might be a little more of a recap, but I guess what are the current valuations for Amazon brands at the moment?
So that depends. As I said, for very big brands, let's say you're making at least 30 million and you have a brand that has a retention, they can go up to 7, 8x total. If those are one-time purchases, like hardline goods, I think around like 5x, 4x at the highest.
Okay, got it. Thank you. If anyone has any follow-up questions even after the fact, feel free to just put it in the chat and we might be able to find some time for it later. But if not, again, we just heard from Klim on what buyers are valuing most. Next, we're going to be hearing from Masha Levin from One Way Ventures on the investment landscape in 2025 for e-commerce. And then after that, we are going to be hearing from Maryna from Maestra, who will be discussing how marketing efficiency impacts valuation. So with that, after we're going to jump right into a panel discussion, but I can go ahead and pass it off to Masha.
Hi, everyone. Good to be here. Can you see my screen?
Yep.
Okay. I'm going to start with a quick story of One Way. One Way is an early stage venture fund based in Boston that backs exceptional immigrant founders. So its thesis hinges on the fact that immigrants are actually building bigger and more successful companies, and that's backed by a lot of data that's come out in recent years, both from institutions like Harvard and from more I would say conventional business magazines like Forbes, which have basically confirmed our suspicion that 80% of unicorn companies in the US have been either founded or run by immigrants. So we believe that unrestrained movement of talent and ideas is foundational to outsized economic success. We're on a mission to break down borders, so we back exceptional immigrant founders from all over the world who have immigrated here and who are building tech companies, and we back them usually at pre-seed and seed stages. Just quickly, why we back them: outsized outcomes, shared values, exceptional abilities. We believe immigrants are actually more hardworking. They have shown grit, resourcefulness. They're able to build bigger companies with less capital, and so on. Very quickly, the market cap of our active portfolio companies is over $5 billion. Our assets under management are over 100. Our average ticket is about 1.2. We have more than 350 people in our expert network. These are our LPs, our advisors, other founders that are supporting our founders. And we have over 60 portfolio companies across the US and Canada. With that, just 2 words about me. I'm a founder myself. I ran my own company for over 7 years before I sold it. It was a DTC brand in the space of furniture and home accessories. Then I joined One Way as an entrepreneur in residence, which means I was the paratrooper that actually went inside portfolio companies and helped them grow, helped them fundraise, helped them build their marketing strategies. And now I'm building my next startup, which is right now in stealth mode, but to be announced soon. And I'm also a venture partner at One Way, which means I source deals. So I have a little bit of an insider lens for what's going on and for some of the common pitfalls that founders have when trying to sell their companies. So I would say deal killer number one that we've seen inside the One Way team and that I've seen personally through my own founder experience is co-founder conflict. So if you're hoping to sell your company, either now or 6 months from now or in a year, you want to make sure if you're not the only founder, you want to make sure that you have the right partners on board. It may seem like an obvious thing, but really it's not obvious because it's the number one actually reason why M&A transactions fall through. And also the number one reason why startups fail more generally. So 65% of startups fail due to founder conflict. That's just a fact. And 67% of buyers walk away when diligence uncovers partner disputes. So if there's tension, if there's any unresolved dynamics with your partners, pause before selling. Buyers and investors detect this misalignment very quickly. I know that during our investment committee meetings within the one-way team, when we discuss a potential investment, we will always talk about co-founder dynamics. Do we think that co-founders are equal, or do we think one co-founder is much stronger than the others? Do we think there's potentially tension there? Any reference checks that we can make from their previous experience. We're going to look very carefully at their LinkedIn's and see what they built before, if they have a successful sale history, and if not, then what happened? Has there been any co-founder conflict? So that's kind of a pitfall number one. Some other big pitfalls that we've seen are data discrepancies. So I think as a founder, it's very easy to get optimistic. I mean, I'm, both a founder and an investor, so I've been in both, shoes, and I can say as a founder, it's easy, especially when you believe in your product. You don't want to, you never want to mislead the investors intentionally, of course, but sometimes founders mislead investors unintentionally. So they didn't mean to mislead, but they were super optimistic. They believe that they will make the numbers, and they show numbers that are a little bit better than reality because they really want that to be true. But you don't want to underestimate that, because if there's an investor that's seriously considering, buying you out or investing into your company, they're going to be watching for this like hawks. So you want to be crystal clear and precise with your metrics, revenue cohorts, your customer acquisition costs. You don't want to show foggy or inconsistent numbers. They kill trust very quickly, and you never recover that. If you have bad news, like for example, if you want to sell, and let's say your last quarter numbers, revenue numbers, are not as sexy as you would have hoped, you want to be the one that explains this first. You don't want them to uncover this. You're going to be much more in control if you actually talk about it yourself, share the bad news, but you can frame it that it's a setback, but it's not really long term an issue for one reason or another. So you shouldn't be afraid to break that and explain exactly what's going on. Number three, deal killer, I would say, is runway. A lot of times founders are, again, super optimistic in terms of how much money they will need. They think that they will need less money than they need in reality, and they underestimate the time that they have until they run out. So if they start raising or trying to sell when their runway is super short, let's say it's less than 3 months, then that usually almost guarantees a weaker valuation. So we tell our founders, if you're raising, go out and raise at least 12 months in advance before you need the money. It's going to take you like 3 months to figure out your ideal positioning. It's going to take you another 3 months to speak to all the investors and choose the ones you like and find the ones that like you. It's going to take you at least 3 months to go through due diligence, and you want to make sure by the time the deal is closed, you're not scrambling for cash, because if they smell that, that immediately kills your valuation. And oftentimes we've seen deals not happen because of that, right? Because if investors see that the team was in a precarious position, they completely change their optics. So runway, being conservative on runway and on burn, of course, is really, really important. It's a major deal killer and a company killer as well. Another caveat to watch is selling to competitors, and I'm gonna share confidentially a case study that we've had that basically shocked not just us but some of the other investors that were in on this deal. It was a really strong company that basically died because of this mistake. So this caveat is watch very attentively when you're selling to your competitors. A lot of times, obviously, if you've built something of value, your larger competitors from the space are going to come and offer you to buy you out. And you want to approach that with caution, because even if you have a signed term sheet with them, you want to keep a backup buyer, because competitors will exploit leverage if they can. So if they will sense that they can put pressure on you, and if they have leverage on you, they will, for sure, they will exploit that much more than a VC or a PE fund, obviously, because venture capital investors are going to be on your side if they're backing you, because they want to stay in with you for many, many years and make money together. It's not the same with competitors. So one M&A transaction case study we've seen, I've personally seen this very closely because I was involved with this team and I helped them fundraise. It was a portfolio company that was building a DTC instant food delivery brand in New York City. Really strong founders. They reached 10 million ARR in just under 6 months. So they were growing like crazy. They were delivering food in New York City for under 15 minutes. And at the time, it was a very competitive space. There were a number of other players competing head to head. And even so, these guys had strong growth in unit economics metrics. OneWay was an early investor. There were a few very large and reputable funds that were on board. So these guys initially were pretty well funded, but they needed to raise their next round. And at that time, they were approached with two offers. One from a competitor player who was funded even better than them, and one was from a large gas station network in the Midwest who wanted to buy out 100%. They chose the offer from their competitor, and they filed for bankruptcy 6 months later. What do you guys think happened? Any ideas? Hello?
They teased them with the buyout and ultimately just left them hanging at the end, and they ran out of money. They teased them with the buyout and left them hanging at the end when they ran out of money.
Exactly. They gave them a really sexy term sheet with incredible multiples. Investors got all excited. They said, guys, you should go for this. This is great exit for investors, great exit for the founders. The guys from the gas station group gave them a good offer, but it wasn't as interesting, right? And the wise people within their advisor network told them, look, guys, don't turn down the other buyer. Who knows what's going to happen? But the founders got all excited. They signed the term sheet, and they stopped the process with the other buyers. They basically literally stopped answering the phones. They ignored them for 3 months because they were so confident they were going to get this done. So the competitor group kept telling them that, it's almost done. They need to get final approval from their board. The deal is going through. They kept dragging their feet until these guys ran out of money. It was too late to raise more money. They went back to the other buyer. Of course, the other buyer said, guys, where were you before? They lost everything. So that was a huge lesson. A real M&A transaction type of case where the founders made the wrong, decision and failed. Any questions, comments?
I was just going to say really quick, just a bit of a time check, Masha, if you want to do some closing thoughts.
Sure. Yeah, I'm pretty much done. I mean, I have another slide which basically lists some of the other, key reasons, like common M&A killers, but I'm not going to spend too much time on it because I'm sure, and you guys know them. As founders, you don't want to over rely on paid media. You want to watch your margins very, carefully in your unit economics. Obviously, that's a key factor. You want to watch your churn. You want to be very clear how you differentiate your brand, of course. You want to watch inventory, make sure your trademark is registered. And of course, you want to make sure you build scalable infrastructure. And Maestra knows all about this. You want to scale your infrastructure, not just your ERP system, but also your marketing infrastructure should be scalable. That's it. Thanks a lot.
Thank you so much, Masha. We're going to go ahead and jump right in to Maryna now, who's going to go over marketing efficiency for exit readiness.
Awesome.
Masha, I think you're still sharing your, okay, there we go.
Can you see my screen?
Yep.
Hi, everyone. I'm very excited to be with you today and share a little bit more about marketing efficiency. So who am I to even talk about that? I'm co-founder of Maestra. I also, before that, helped to build another marketing technology business from 0 to over 300 million in revenue. We had a successful IPO exit. And in addition to that, I'm part of multiple venture capital firms, and I invest myself personally, love marketing and GTM. So happy to answer any questions as I present, as well as if you have any questions afterwards. Let me ask you a very simple question. If you were to sell your business tomorrow, what valuation would you expect to see on the term sheet? And what number do you think buyers are actually willing to pay? What kills exits, it's not the revenue, but the growth efficiency. Klim was talking about different milestones that you need to hit to get to specific type of investors. But investors also care not about your revenue growth, but how did you generate that revenue? If you were to stop your ad spend tomorrow, will your business collapse? Or is going to be more sustainable, scalable business? And depending on the answer you give, your multiplier is going to be go up or down, and you can lose millions of dollars. And that is why we're here today to help you prevent that from happening. So what numbers are actually and what is important to investors? LTV to CAC efficiency ratio is one of them, because if you can spend money more efficiently and bring more repeat visitors and repeat buyers, then your marketing is more scalable. And investors love that. Also, recurrent revenue. You have a half subscription model or order replenishment, then investors look at that as there is some predictability to the business as well. Brand loyalty. Do you have a loyal customer base? Or every time you have a new release, you need to spend a lot of money on Google or Meta? If you have those repeat buyers that love your brand, they're going to come back and purchase, then it's a big plus for you. And lastly, do you own your data? Because as you know, there are a lot of shifts happening right now. Your cost per acquisition is going up. Google is very unpredictable, as well as Meta. So they have a lot of control over your marketing. So can you own the relationship with your customer? Can you collect the data? And especially with cookies going away, that is going to also very beneficial for you. All of that help buyers to also evaluate what multiple you're going to get. Let me put this into perspective for you. If you were to double your ad spend tomorrow, an overall marketing budget, will your cost per acquisition go up or stay the same? This is what investors are testing for, because they want that CAC to at least stay the same or even go down, because then they know that you know how to spend additional budget that you have for marketing, and you can spend it efficiently. So investors not just looking for vanity growth, they're looking for efficiency. And this is where retention comes in, because here's the kicker. Because if you increase your retention just by 5%, you can boost your profits by 25 to 95%. And it's not even me saying that, it's Harvard Business Review. So better retention you have, more scalable and predictable your business is. And that is going to be contributing towards your positive valuation. That said, this is what I see happening in the world right now. I spoke with over 100 marketing leaders as well as CEOs over the last year. And when we look at their backend, it's a mess. They have one tool for email, one for SMS, one for the website, and so on. And of course, for the marketing team, it's so difficult to manage all that. Instead of focusing on the strategy, they're focusing on managing teams, and then integrations breaks. Then you don't really understand your customer. There are quite a few challenges that come in along, and customers see that on the other end because the experience is unpredictable. And sometimes it's good, sometimes it's bad. It depends. So all that create a chaos. And then when investors are looking at business like that, they will think, okay, it looks like I would need to rebuild the marketing foundation. And that is going to be something that is going to impact your multiple as well, because they're looking at this as a risk factor. That said, this is what we see some of the top businesses are doing right now. They have customer at the center. They move from channel-centric marketing to customer-centric marketing. When you understand your buyers really well, you understand their preferences, what they bought before, as well as you can communicate in real time with them across website, email, SMS, and any other channel that you have. And then the experience that buyers have, it's more personalized. They feel you are building a relationship with them at scale. They love that. And investors love that as well, because there is more, your marketing becomes more predictable, and that translates to higher LTV as well as lower CAC numbers. So let me give you an actual example about how it actually translates into practice. Here, an example of furniture fair. It's like a business over $100 million. And you would think, okay, everyone is talking about how I put the right message in front of the right buyer in the right channel. Here, what they did, if someone is visited a website and saw a sofa, Furniture Fair now using Maestra recommends like a nice lamp, as well as nice picture that goes along with that. Also, that message is being translated across all the channels, like paid media, email, SMS, push, even offline. Customer journey becomes connected. It becomes unified. And that is actually the reason why we built Maestra in the first place. Because in addition to just looking at your marketing as one channel, like email or SMS, yeah, you can have your email and SMS, but then in addition to that, you can personalize a website to every consumer that comes to your website. If they're a new or repeat purchaser, what they bought before, all of that is being considered. The website adjusts in real time, as well as you show them relevant product recommendations. You can even show them personalized price. So depending if it's Julia or Robert go to the website, they could see different price on different items. And lastly, analytics here. But the best part of all of this is customer data platform is our ability to store the data about your customers, because then you know their previous purchases, their behavior, their preferences, size, and so on. And then all of that can go into personalizing all the channels and all the messaging. And it creates a virtual cycle for you. And this is the foundation that investors are looking for as they acquiring businesses, because then your business becomes more scalable. And here's an actual example. We work with United Colors of Benetton. It's a global fashion brand. We work with them in one of the regions with 22 stores, e-commerce website. They have also mobile app, in-store kiosks. So it may seem that the business might be a little bit complex, but we can also handle the easy brands as well, because it's less work for everyone. But what we did for them is we created 61 cross-channel flows, as well as targeted promotions, A/B testing. And what we saw at the end, 37% increase in EBITDA. And Kim was talking about that being one of the metrics, right? So as well as we saw increase in LTV and AOV by over 20%. And lastly, NPS skyrocketed to 82. And the best part, that very small team of 3 people in an agency handled all that. And we helped them to cut cost. So this is what scalability is. You can accomplish way more with a small team, and you can impact EBITDA significantly. Think about your own business. Is your business scalable? Here's another example of Jolene. This is one of the top swimwear brands in the US. They decided to go with Maestra on December 1st. Within a month, they were already live in our platform. And on May 15th, they already saw 17% year-over-year growth that they are super excited about. That was one of the best board meetings they had when they presented this number. So when you think about your own priorities, what is getting to the top? And if just 1 month of transition and seeing incremental 15-20% could get to that top line of your priority list. So what's in it for you? When investors are looking to invest, they are looking at your marketing and trying to decide, is it more like a kindergarten projects when you have a lot of tools, a lot of channels, but nothing is really connected well to each other and your marketing team is just doing busy work? Or you have the right infrastructure and the right foundations when your team is very efficient, can deliver quickly, and when you can also create personalized experience for every single user. Then you can get higher exits, your margins are up, your retention is up, you're happy because your investors are going to give you a better valuation. So when you think about potential acquisition or potential investment or having someone acquiring your business in the near future, then think about the marketing foundations that you need to have right now, because it's better to put it in place at this moment instead of just 1 year before the acquisition, because at that point it might be too late. Investors want to see consistency across multiple quarters. And I hope when you have investors knocking to your door, then you're going to get a premium instead of discounted rate. So I'm happy to answer any questions you may have. And Julie, you may have a question as well.
Yep. Rob actually had a question that he put in the chat. So what is the preferred benchmark for the LTV CAC ratio?
Yeah, maybe we can ask Masha and Kim, since they're actually evaluating companies.
The higher, the better is the simple answer, right? Like,
so Dave is right.
Yes.
100 to 1.
I mean, obviously, there's never an ideal answer because different investors are going to have different expectations. But we've seen one DTC brand that we have in our portfolio, which is a fantastic company, growing very quickly. But they were showing a LTV to CAC ratio of only about, I think, 3. And when they went to fundraise, they didn't have an easy time, because a lot of the investors loved the growth but didn't love the ratio. So I think they've spoken to over 100 investors before they raised. They did end up raising successfully, but I know that right now they're working on improving the ratio. What I've heard is over 5 is a number that investors like. I don't know what others here have seen or heard, but over 4, 5 and higher is considered good.
Okay, great. Thank you so much. I know we are rapidly running out of time. Oh, go ahead.
I was just saying, I would love to better understand the KPIs kind of across the board from, CAC to AOV, or ideal gross margins, or preferred EBITDA margins. I want to say I saw on Masha's slide that it was 60% plus on gross margins, and I believe it was 20% plus on EBITDA. Is that right?
That's correct.
And then what about like CAC to AOV? What's a preferred multiple?
I don't know. I mean, I think maybe even the Maestra team will have better data here than me, because they have a lot of clients and they've seen different benchmarks across. I would say it depends on the vertical a lot, right? Because AOV also heavily depends on the vertical that you're in. You're not always going to have a high AOV. So I think from our end, we're not really fixated on AOV at all, if that makes sense.
Yeah, similar for us. We don't normally look, and not as many customers on our end trying to do CAC to AOV ratio.
More important is CAC to LTV.
Yeah, LTV to CAC normally.
I was going to say we are going to head into the panel discussion, but it sounds like it has already started. So again, if there are any questions during this time, I would go ahead and raise them now. I think feel free to put it in the chat, which looks like we do have a question already from Hannah about the average payback period. I was gonna say if anybody, Klim, Masha, Maryna, feel free to just jump in, I think, for each of for any of those questions. Or Hannah, was there anything more specific?
Yes. Hey guys. Yeah, so just to follow up on that point about caring more about LTV over CAC instead of AOV over CAC, I think it's because most DTC brands are losing money on day one to acquire customers, right? And then they are leaning on retention and subscriptions and repeat buyers to, well, number one, get back to break even, and then hopefully make a little bit profit above that. So that payback period, let's say I'm acquiring customers on day one at 0.8x ROAS, return on ad spend, right? So I'm in the red. Now I'm not even talking about return costs. I'm not talking about agency fees or a product cost. It's straight up just like I spend $80. I spend $80 on advertising and make $100. So I'm at 0.8x ROAS. Now, how do I get to the 3x LTV over CAC? If that's day one for me. So and that's even good, right? It's like some brands acquiring customers at like 0.2 to 0.4x ROAS. So how long would investor be comfortable until like, okay, 6 months later, 6 months is your payback period, and anything after 6 months, that's where you're gonna get your profits. So that's what I meant by payback period. If there's any insight about that?
Are you asking me, Hannah, or?
Oh yeah, I mean, I'm asking all three of you. If you all want to share your feedback on that.
I mean, I'm just gonna make one comment that we don't have a harsh number of months, right, that we look at. I mean, it's fine if it's even 3 years, right, as long as it pays back, right? So if it's fine to have a longer horizon if you really believe your customers are coming back, year 1, year 2, year 3, and you're paying this back in 3 years. I don't think that's a problem as long as you can show that. Sometimes you don't have enough data to show that if you haven't been on the market for that long, right? But like having a lot of the investors, at least in the VC space, the private equity investors are more they're coming in at later stages, so they have different horizons. But early stage investors like venture capitalists, they have a very long-term view. So if they believe in your product, they're going to be okay with 3 and even 4-year paybacks as long as they see the light at the end of the tunnel.
Yeah,
Gotcha.
I would echo on that. If you didn't hit the cap, I mean, like of the total customers you can acquire, that's completely fine. As long as your marketing is scalable and you can acquire customers every month and even more of them, payback doesn't matter.
Got it. But then during that entire time, you're not profitable and there's no EBITDA and you're just burning cash. So then this is like how would this tie into the, okay, we have to show growth and profitability and high LTV over CAC while also burning cash and waiting to get our money back. So it's kind of like, how do we show that story?
I mean, obviously you have to find balance. You cannot be burning cash for 5 years in a row and not showing profits. That won't be interesting. But if like you can prove that you can be profitable like in 1-2 years, that's completely fine. That's more than fine, I would say.
Yeah. And Hannah, this is where strong retention numbers and repeat purchase rate is important because they might not be buying. You might not be recouping all the ad spend immediately. At the same time, if you can show the cohorts of your early buyers that are still buying from you and you are making those profitable, then at least you can have the story of, yeah, I have a really strong, loyal customer base and I can recoup all the ad spend.
Got it. I don't know if I'm taking too much of everyone's time, but I would like to ask about the opposite. What if a business is super profitable, high AOV on day one? So instead of waiting for 3 years to get that money, they're getting it on day one. Now, because they're getting on day one by selling bundles and discounts, they don't get the retention. They don't get a lot of repeat buyers because they're selling a lot on day one. Is that more appealing because now they're showing profit on day one and cash flow positive, all of that, and they're at scale? Would that business also be attractive, but it's not the traditional model that we always see?
Yeah, I mean, like obviously it's attractive. It's just the question as well of a market cap. Let's say it heavily depends on the context. If that business you're describing has a market cap, let's say $2 million, obviously that's not attractive even if they're profitable on day one. But if
Right.
someone is burning money and they can get to 100 million revenue in a few years, that's much more interesting than a profitable business. So it's all about the context here. I mean, like
Got
short
it.
term, obviously it should be more attractive and you're making profit. But if you can capture like 90% of your niche while burning money, that's completely fine.
But what if this business I'm talking about is over 100 million in revenue? Is that extremely attractive then?
Yeah,
Okay. Got it.
that's true.
Thank you, guys.
Any other questions? If not, I have one I can go ahead and ask. So I'll also put this in the chat as well. But for Klim, Maryna, or Masha, feel free to jump in. But how do you evaluate a D2C brand's marketing personalization maturity, or Maryna, I'm sure, and use of first-party data when considering an investment or acquisition?
So how we think about marketing maturity, it's more around two components. First, how many flows do you have? It means this is not campaigns. You just set them up and they're running on the background and generating revenue for you as you sleep. So as of 5, 10, normally we see our brands have around 40. So this is the benchmark approximately. Some of them having 70. And the second component is around how many channels you are using in personalization. So it's just email? Is it email SMS? Or using email, SMS, website, app, maybe even offline, and ads? So more channels you're using, this is the second dimension. So just think about your marketing. How many flows are running there as I'm sleeping that are generating revenue, and how personalized those flows are, because my customer is seeing the same message across all the channels.
Thank you so much, Maryna. I know we are almost up on time. So with that, I wanted to just see if there's, for Klim, Maryna, Masha, if anyone had anything else they wanted to close out with.
Yeah, I would just let me just get back quickly to Hannah's question. I believe right now, every investor is actually looking at profitability. Though, if you can be unprofitable and prove that you can be profitable 1-2 years, that's more than fine. But right now, majority of funds, strategic equities, they're truly looking into profitability, because right now is not the best times for a business in general, and profitability is the king right now. Even though like revenues were king 5-6 years ago, and if you can scale really fast, that worked. Well, today the situation is a bit different. But if you can prove that you can be profitable in several years, and you can prove it on numbers and data, that would also work.
Thanks, Klim. And with that, we are essentially up on time. So thank you guys all so much for joining. I really hope this was helpful for you guys. We are going to be following up with the recording of the webinar as well, and then all the contact information. So we will be sending that out to everyone. But if anyone has any last thoughts they'd like to share, again, feel free to.
Thank you, guys.
Thank you all.
Thank you.
Thank you.
Thanks, everyone.
Bye.
Bye.
Thank you.
See ya.
Bye, guys.